Well, hello, everyone. Welcome back to the Financial Beast podcast. I am your host, your BFF, your best financial friend forever, Eric Miller. And just did a conversation with Amit Gaglani, who is a physical therapist, had a physical therapy practice, and went through an exit. And we had a really good conversation on all the things that someone would need to do to make sure that they exit their practice and get millions and millions of dollars for it. We went over all the things that the strategy that he used. We went over who he talked to, what the things that they were looking for, and how he built his business so that he could sell it for millions of dollars. And then we also talked about, like, what do you do with all this money after you get it, and having a plan for that. So he definitely dropped some gems. I think you guys are all going to like it. Please, as well, like, share, subscribe, leave some comments. Let us know how we're doing. And again, as always, if you are in the need of any kind of financial help, which I know a lot of people are, do not hesitate to reach out to us. Go to Econologics.com, schedule an intro call, and get in touch with one of our people so that we can help you. Okay. You guys enjoy the podcast. I'll see you on the next one. Yeah, we called it practice transition, and we still do it. Obviously, we have like an assessment we give people, but it's, and we still focus on it, obviously, because I think the vast majority of PTs give more thought to planning a vacation than they do to planning their exit at this point in time.
Yeah, they do. I've been doing a lot of research because the book that I'm writing, right?
Yeah.
On exit planning and increasing valuation of practices. And they're saying that, and different sources cite this, that 48% of practices don't have an exit plan, which actually I think is a wrong number. I think way more practices don't have an exit plan. I think way more percentage of plan.
Yeah, I would 48% is a huge number, but it's probably more like 75%. If not even higher.
Because the number of people who don't even have a business plan. So if they don't even have a business plan, how are they going to have an exit plan? So
yeah, I can't remember, at least when I was like really advising in the chair, how many people, when you asked them like how they're going to exit out, actually had a intelligent answer to that question.
Yeah.
They were like, I don't know. I didn't know what else I was going to do.
The more I dig into businesses and the psychology behind it and things like that, you see that people are more worried about the day to day. How am I going to get through this week? How am I going to get through next week? Where am I going to get my next new patient? As opposed to what am I going to do 5 to 10 years from now? And it depends on what season of their practice they're in. 0 to 3 years, they're just trying to figure out, how do I put systems in? Who's my next hire? How do I just do the basics, like literally pay my bills and things like that? Yeah, 3 to 10 years out, they're trying to get a little bit more advanced systems in their place. They're trying to strategically hire people to kind of put hopefully some management in. But some people have just been day to day that whole time, and they have the day to day mentality. Like, how am I going to get through this month? Now I have employees. I feel like I even have to work harder because now I got to pay employees, as opposed to these employees are supposed to be producing a certain amount to bring in revenue.
Mm-hmm.
So. And then you got the people who are like thinking, hey, I'm going to retire probably 5 years from now. So yeah, somebody's just going to pay me money at the exit, as opposed to let me start putting my ducks in a row now so I can get the highest value at that time. Or I want to transition to my family, let me put my ducks in a row, so put systems in place so it's a better transition at that point. So it's the lack of planning that I notice.
Yeah, I think you're right. Which kind of prompts the question, do you remember when you made the decision to exit?
I think 3 or 4 years before that, I actually did the exit. I started.
You did? Was it
into practice? Yeah, okay. Because I started taking a look at the landscape. I started talking to what we call strategics, which are known physical therapy practices, large ones that are looking to acquire. I started to ask them, how do you value practices? I started to talk to different private equities. I spoke to you. You introduced me to some people, but I took a look at the other landscape to see how is everybody valuing it. They told me their methodology, and then I basically went to work for those next 2 or 3 years and figured out, like, okay, this is what systems I have to put into place to make me look attractive. My goal, honestly, was to have other people salivating over my business, multiple people looking at it saying, we want this, how do we get this? That's where you get the advantage of being able to negotiate and being in a position that you're in the driver's seat, as opposed to somebody's giving you an offer and you're like, okay, I'll take it. I need this now because I didn't plan far enough ahead of time.
Yeah. I'm going to use that term, salivating over your practice. That's a great way to put it. And, I would tell you, most people don't. I mean, what you did was so smart because you basically went to the people that have the money, which these groups have the money. And you went to them and you asked them, hey, what the F do you want? Yep. You know, like, what do you want? What does your
ideal practice look like that you want to buy? What does it look like numbers wise? What does it look like management wise? What is your headaches? You know, tell me your headaches. So I wrote down all their like ruins and all the headaches that they have and what they don't want too. So, you know,
were you surprised at all about what they wanted compared to what you were building?
There was some alterations that I needed to make because,
do you remember what those were?
I remember one thing is they really don't want the owner that involved. Yes, they want the owner involved, but he can't be the keystone in the whole thing. Whereas if he steps out, then everything, you know, crumbles. Because think of it from an investor standpoint. They're investing in this company and something happens to the owner. Either he decides that he wants a life change or, you know, he gets ill. All of a sudden, they can't have their whole investment crumble because of that, because they're paying a multiple on an EBITDA formula, which means they're giving you a couple of years in advance, depending if they're doing a 3 multiple, 4 multiple, 5 multiple, they're paying 5 years of what you've, you know, created ahead of time. So they can't have it crumble that fast. So the best practices are the ones that have system and key employees in place that are part of the management, you know, scenario, management group, that if the key employee, meaning the owner, steps out for a month, the practice is still humming along and can do things from a business development standpoint, from an operations standpoint, from every single standpoint. They don't want that person that integral. Now, they would love when they buy it over that he's still involved in, he or she is involved in the day to day, you know, because they want that person to just manage over everything, but they want the finances to improve, not to go below. So they have to be very careful on how they're setting up their investments and how they're setting everything up.
Yeah, they definitely have attention on that, don't they? And so you made a good point there too, of like, what are some of the key areas that most, I mean, we'll say PT, but man, this could relate to any healthcare business at all, to be honest with you. What is it that the buyer would want to see? So core leadership that's not dependent upon just the quote unquote owner person, that for the founder, so to speak, that was been there, and that you have some good tenured people that can, you know, run the operations for the business. That would be one. I would say that. What's another big thing that they look at? I mean, obviously, I'll go to number one. I mean, obviously, they're going to look at your margins too. They want to make sure that this thing actually can create some positive cash flow. Yeah. So I would say that's probably that's still got to be number one as far as what's going to determine the value of your business.
But then it depends on who you're talking to. If you're talking to a strategics, most of them are big enough that they have already negotiated rates that are higher. So what they're looking at is they want to see what are the buckets of your patients that are coming in? What insurances do they belong to? Because if they belong to insurances that they have way higher margins than you do, that goes into their calculations, right? Because if they're getting paid, I'll make up a number, $150 for this insurance, and you're only getting paid $100, but you see a lot of these patients, they're putting that in their formula, and they're like, "That's great." You know, as soon as we acquire, we're already going to start making more money. So that's a part of it. So to understand who you're marketing to.
Would you be able to use that to negotiate a higher price, or are they just 100%. Like,
but
you would?
That's where you have to do your homework and you have to know who you're talking to. That's why setting a plan ahead of time and understanding who is the acquirer and how do I actually position myself at the greatest advantage for that acquirer. And it's going to be different for a strategic that you're talking to, or it's going to be different than a private equity company that you're talking to.
So and to do a little homework. Explain the difference between those two right there. What's the strategic private equity?
Strategic would be a large physical therapy company that has multiple offices already, has their kind of blueprint in their operations. They already know how they're doing things, and they're just fitting you into their model.
So there's just a privately owned, typically.
It could be a privately owned. It could be a private equity owned entity. Okay, but they're a large entity that have everything already figured out. They have a C-suite. They already have, billing rates and negotiated rates. and they're just looking to add you into the fold.
Okay. How big are these usually? How many practices?
It could be from 30 offices all the way to hundreds and hundreds of offices across the country, or it could be just concentrated in one or two states, or just, one state.
Yeah. Yeah. And they'll have like a number of partners in this group.
Yep. If it's private equity owned, which is different than private equity. And what I mean by that, I'll explain. The strategics are already physical therapy companies. Then you have private equity companies who want to get into the healthcare market, right? They might have other healthcare verticals. They might be in dentistry. They might be in ophthalmology. They might have surgical centers, but they don't have physical therapy yet. And they want to add that, right? So they're hunting. And depending on who you're talking to, some of them may have lost out on previous bids, where that knowledge helps you to realize that they've lost out on previous bids. So they may be more apt to bid a little higher on this one because they want to get it.
Mm-hmm.
So doing your homework on the acquirer actually helps you to strategically position yourself for the best possible position.
Yeah. Okay. So EBITDA is a value driver. Core leadership is a value driver. I would say a third one is and I'm talking about for someone to get full value or the highest value possible, would be that you are growing. Like you're seeing more new patients every year. I mean,
year over year.
Yeah. Someone's there has to be a statistic there that they're going to look at and say,
well, okay. It's twofold. They want to see that growth, but they also want to see where are your referrals coming from. If they see a greater than 20% concentration coming from one referral source, that's a red flag for them. Okay. For obvious reasons, just like an investment, right? You don't want all your money in one bucket because you're not diversified. Your referral sources have to be diversified. And that only really happens if you have proper marketing going in, and you're getting it from a broad spectrum of, patients are coming to you from the internet, from doctor referral sources, from community relations, from returning patients, as opposed to the owner having a good relationship with one ortho surgeon that's sending them all their patients. That has less value.
Is that easy to measure inside a PT practice?
Yeah. Because when they're going through their due diligence, or when I'm helping somebody with their due diligence, you're looking for, show me your patient breakdown. Where are they coming from? Show me your patient concentration. Over the last year, where did you get your patients? What insurances are you getting them from, and your referral sources, where you're getting them from. That's where we're looking at the percentages to see, because at the end of the day, for whoever's purchasing it, if you're in their mind and understand that they're looking at this from an investment standpoint, it's an objective measure. So look at it from that point of view. And if you build your company from that objective standpoint, then you're going to be making sure that your referral sources are diversified. You're going to make sure that you're getting the top insurance companies that you want to service, and that you're looking at your contracts and you're weeding out the other contracts. You're making sure that your staff, understands their roles and their production in that role, and that they have a measure that they're being measured by, and they even have bonus systems in place so they don't want to leave per se, or they have contracts in place that they're not going to leave easily. Yeah.
I'm going to ask another question about looking at your practice as an investment. I want to finish up on these value drivers right here. Maybe two more. I would say is the compliance issue a big area that they look at of your business?
Yeah, because they're going to ask you for a smattering of different insurance EOBs, estimation of benefits. So they want to see things are being billed correctly. They want to see are you up to speed, especially when it comes to Medicare. Medicare is the big gorilla. So you want to make sure that your schedules reflect properly, you're billing properly. They'll do their due diligence on you to make sure that you have nothing, legal issues that are going on in the practice too. But yeah, nobody wants to take over a problem.
Yeah, for sure. We've seen that happen, and it's like, oh my God, that's ugly. Okay, but so that's 4, right? Compliance, growing new patients, core leadership, profit margins. Would we close it out with? Is there a 5th one you think?
I think we could talking also a diversification of insurances that you're seeing, but I think that can go along with patients and patient acquisition, and that you have as you know, in physical therapy, our patients are only our patients for, let's say, 4 to 6 weeks. Yes, we want them to return. So you put some energy into returning, but there is a component of how are you getting your new patients all the time. So as long as you have steps in place and you can show that you have a track record of this is how we do it. And it's not because I'm, really best friends with an orthopedic surgeon or one doctor that's sending us all the patients, that you have a system and you can show that system is generating new patients. That's what they love to see, because they can be a little bit more hands off on that part of it.
Yeah. And then how important are the demographics where you are, your location?
It is to a certain degree. Like, as you know, when I was part of a private equity company, one of my roles was I was national director of payer relations. So I would take a look at, we were in 15 different states, and I was the one negotiating rates with insurance companies. So in certain states, our reimbursement was way higher, but our cost of a therapist was way lower. So our margins were huge. So guess what? We're going to open up more offices in that area. We're going to open up way more offices. And then in other areas, you had the opposite. We had lower reimbursements and the cost of staffing was way higher. So, you kind of shy away from that. So if you're a private equity company or if you're a larger entity and you're looking to acquire, you're looking for the guys that have the best margins. And usually that means efficient operation.
Yeah. You're pretty good at negotiating too. I know that. Do you think that PT owners negotiate hard enough?
Because they don't feel like they're in a position to. If you have a couple offices, the insurance company don't even return your email or your phone call. So how do you negotiate with somebody who's not even communicating with you?
True. Yeah, that's true.
So
okay.
There are areas, and here's an example. If an insurance company it's a brand new insurance company coming to the area, you have the ability to negotiate because they are looking for providers and they don't have them yet. Once their panel is full, you lose leverage.
Okay. Yeah, I got it. That sucks.
It does, but I've been in those shoes that I've been on the side of it where I couldn't do anything. And I've been on the side of it where, even as a small guy, that I was able to negotiate higher rates. And some people think it's all about the rates. It's not. It's also about your preferred status. They can give you the highest rate, but they're never going to send you patients. Now you're on their panel. They can show we have this many providers on our panel, but then they have a preferred category where they send all the patients. So not only do you want a good rate, but you want to negotiate that you're on the preferred panel.
Hey, what prompted you to start looking at your practice like an investment? And then what are some things that, like, when you had that, because I'm assuming when you first started out, you're just a practitioner, right? And you wanted to treat, and I wanted to own a business because that's what, everybody does. It's the American dream, right? I want to own a business. I want to have my own freedom. Ha ha ha. And then at some point in time, though, when did you realize, like, man, I have to understand how to treat this thing like a business, and that it is an investment? Like, how early on in your career did you realize that?
There's two classes of practitioners. One that opens a business because they're looking for a lifestyle business, and another one that wants to open it because it's a true business. Okay. The lifestyle guy is opening because they want to improve their lifestyle. They want to be able to go in a little bit later, come home and have a good quality of life, go on vacations, but they're just looking for status quo, right? Then you got the person who's like looking for a true business, where they know even if they're not in the office, the business is not only doing well, but it's actually increasing year after year. Okay. So I think I had a shift in my early days of being a physical therapist when I opened my practice. I quickly realized that I didn't know what I was doing in business. I had no concept of business. I knew how to treat patients. I was board certified as an orthopedic clinical specialist. That felt easy. But I was like, well, I don't know anything about business. Let me ask my friends. Well, they don't know what the heck they were doing. They were giving me advice based on what they thought was right. And then I realized
they were all doctors, weren't they? Who are just as bad with money as everybody else.
No, but they didn't have any business acumen. Here we are, educated in treating patients, but not educated in running a company. Everybody has an opinion, but that doesn't mean that opinion matters, right? Or it's a good opinion. So I realized I need to get educated on the understanding of a business and how to actually increase the business. So I went down that road. And as I started putting things in place into the practice, it started to grow. As it started to grow, I realized that I needed some financial help, in the sense that, how do I manage the money that's there? I want to put it in this stuff. I don't have time to put it out. I don't want to worry about stocks. I don't want to worry about it. And, that's how you and I had met, a long time ago. That's got to be like maybe 20 years ago. That I realized.
I don't think it was quite that long ago, but it was probably 15, somewhere around there, 12, 15 years ago. Yeah.
But you had me read some books. Actually, I remember that you're like, read this book. And I started reading and realizing that I actually want a business. I don't want a lifestyle practice.
Yeah.
And that started that whole road of understanding that I got to be financially minded and understand that it's way easier to spend money than it is to make money and to actually hold on to that money.
Yeah.
And those kind of moves and discussions that we would have actually, helped me to realize, that, finances are of not only key importance, but most physical therapists have no idea. They don't understand, like you and I were talking, they don't understand the difference between profitability, EBITDA, and cash flow. Mm-hmm. And those are essential for an owner because they're going to hear one thing from their accountant. Sure.
Talk about those three.
Accountants will look at your profits. Okay. Investors or like yourself, financial or wealth management people will look at EBITDA. A business owner will look at cash flow. What is in the bank and what can I spend? The misunderstanding there is they'll walk away from the accountant. The accountant will say, you had a great year last year. And the business owner will look in the bank and go, but I don't have any money. Yep. What do you mean I did really well last year? I don't have any money. It's the misunderstandings that, that they have that they don't understand. Well, profitability doesn't mean that, you paid your taxes. There's also taxes that have to come out of it. Now, obviously, it depends how you're set up. If you're set up as an LLC, it's different. If you're set up as a corporate structure, it's different. But generally speaking, these are the misunderstandings that a small entrepreneur will have.
It's true, though. And, that's why I will always start out with any owner and tell them, hey, look, I'm going to tell you right now, your business, first thing that you got to know about money is that your business is going to try to spend everything that it makes and then some. I do not care what your profit and loss statements say at the end of the month, because it doesn't mean jack ola to me, because I know that at some point in time, you're going to get a call from the accountant and said, hey, congratulations, Amit, you had a banner year. You owe $120,000 in taxes. And you're going to look at your accounts and be like, where is it?
Right.
Where is it? So the financial control of the money, I think is really the first thing that people should learn, as opposed to like worrying about the profit and loss statements, and trying to reconcile all that, because that, again, I think that's an afterthought, because the money had already come in and gotten spent at some point in time. Yeah. So it's really important that they establish that financial control.
This, for anybody that's out there that's just starting their practice and they're listening to this and they kind of feel what I'm saying, one of the biggest pieces of advice that you may have given me, or where I learned it from, after 20 something years, you forget where you actually learned something from. You kind of make a lot of things your own, but just the financial allocations, putting monies in different buckets. That you're going to have to pay quarterly taxes, right? So if you know that your quarterly taxes, there's 13 weeks and you have to pay $13,000 at the end of the quarter, every week you do it as an automatic draw. You put it into a tax account that says $1,000 out of my bank account goes there. So when you look at your account, you don't see money that you want to spend because it's not yours. It's not even there. It's in a separate account. At the end of the quarter, the money's just sitting there to pay the tax.
Yeah, you were really good at that. You got really good at that towards kind of like the end, as far as how you're allocating money and where you're putting it, and for not just taxes, it's money for your household. It's money to accelerate your personal debt. It was money for you to invest in other assets outside of the business. And I think people forget that the business has the ability to, generate enough cash flow, or needs to, so that it can serve your household as well, in that shape. It's not just there for money to sit in the practice. Cause you do that, it's going to get spent at some point in time.
Yeah. So you have to have your allocations in your reserves, right? God forbid you had a slow month, but once you've hit your reserves, that's your goal. Now you can do other things with it, but get your reserves into the positions that you need, and that's your safety net. And then take a look at what you want to do with the rest of it, but have plans.
Yeah. Going back to exiting, I think the stage of exiting what stage of exiting is the most stressful?
Well, once you go under an LOI And you go through that process, due diligence starts. And due diligence is stressful in the sense that they're asking for a lot of information. They're giving you a checklist of lots and lots and lots of items, And if you're a type A person like me, you don't like items just that are unchecked sitting there. So I'd get to the office super early in the morning and start checking off those boxes, like done, 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 done. But it's a lot of stuff. It's not just a couple things, and it's stuff that you have no idea where it is. You're like, I don't know where this is. I have to figure where this is out.
What were some of the things on there that you were like, what? What?
So in my early days, you would sign a contract and you would file it away, and it automatically gets renewed year after year with an insurance company. Insurance companies might send something out, but a lot of times they don't, and they make alterations to those contracts, and you have no idea where that is. And you're looking and you're like, I didn't even know they made a change to it, but they make changes to stuff. So when they ask for the original contract, you're like, well, where's that? And then you read the original contract, like they're not even doing this anymore. They've made changes. So you don't even know where some of that material is. And you would think it was easy. Oh, call the insurance company.
That's what I was going to say. You can't call they want.
You can call.
They don't even have a record.
Oh my God. It's like you're going to bang your head against the wall because they can't supply it, or you're just talking to the wrong person, and you just,
So what do you do? What do you do if you can't find it?
You can only supply what you can supply in certain circumstances.
Yeah.
Due diligence is also, they understand, like, what, if you've been getting paid, let's see your record, you've been getting paid X, Y, and Z for this long, chances are it's not going to just automatically stop or change.
Right.
A lot of times we want the contracts because we want to see, if we have to fight something, who do we call to fight something? Meaning, what is the right department if we see that the bills are not coming out right, or something is wrong, or there's an authorization issue, who's the right department? That we want to know, what does the contract stipulate? How many patients an hour, or just, how are they paying? How are these contracts set up? Is it a case rate? Is it a daily rate? Is it, a fee for service type of things? These are kind of spelled out in the contract. And the more you understand them, the more you can actually mitigate your own risk.
Yeah, I believe that. And while you were negotiating with the group, okay, because you're not one that's kind of afraid to ask for money and not afraid to negotiate. Whereas I think a lot of owners are afraid to negotiate with a bigger group like that. And
are you talking about when the entity was looking to acquire me?
Yes.
Okay.
Yeah. So, and I know that, we were kind of in the due diligence phase right there. I know that was stressful. And I think the bottom line is like, try to have all your records as up to date as possible. Yeah. Okay. Have all your licenses for all your credentials for all your PTs up to date. Your leases, if you have leases, make sure you have all that up to date. All of your corporate documents, make sure you have all those things up to date and in a place where you can get access to them. Yeah. Because I think that probably, if you can supply that stuff to them quickly, that's a good sign. They like that, don't they? They're like, okay,
yes, this guy's like, he's on it. He has it organized, it kind of tells them what's going to happen later. I had, people tell me, we bought a bunch of practices, but we're really looking forward to yours because of we see huge opportunities there.
Yeah. Yeah. But if you take like 3 weeks to get a P&L to them, they're going to be like,
Yeah. It's important, and I don't think owners realize, they just think that the accountant does everything for them, which it does, but they should never forget the fact that the accountant's job, and the accountant looks good when you pay less taxes every year. That doesn't necessarily mean that the value of your company is increasing, okay? Because they're looking at things like, how do I make this guy pay less and less taxes? Now, that might actually reflect poorly on your EBITDA in certain circumstances. If you're getting ready to sell in the next couple of years and your accountant is actually putting something in the wrong category, not because they're doing it on purpose, but they're looking at it like, well, if I put it in this category, he's going to have to pay less taxes. But by doing that, the valuation of the practice actually goes down. But he's not thinking that. If you're not sharing your goals with your accountant, and your accountant doesn't know that, or the owner doesn't realize, like, no, I bought this table that's going to get depreciated. That don't put that in an expense category where it goes off, and then I have to pay less taxes, but there's still value there.
Yeah.
So it really depends. And those conversations either need to be had, or you have to have somebody on your team. When I'm working with people, I'm looking at that aspect too.
Yeah. It's crucial. You got to have a power team that is all coordinated, with you as the goal of helping. And, if that team isn't coordinated, if one person's doing this, the other person's doing that,
Correct.
I mean, they're just going to hurt you in the end. So you do need a power team, I think, when it comes to, especially, prior to exiting, that is on the same page. Like, I am selling this practice in 4 years, 5 years. I need to make it look as good as I possibly can prior to selling. Everyone do their job so that happens. I think there's
really a lot of misunderstoods out there too. Most companies, when they're buying it, they're doing an asset sale, right? They're doing an asset purchase. They're not doing a stock purchase. So therefore they're adding up all the assets, and everything else you want to go towards goodwill. The higher you can put towards goodwill, the less you actually end up paying in taxes.
Yep.
There's different strategies that are perfectly legal, but you don't know these strategies unless you're starting them ahead of time.
Yeah.
And some of them are mitigating your taxes and talking to, good financial professionals ahead of time, much ahead of time. Like, what do I do? Where do I put these funds so I can actually, control my tax point of view? So, all of this is planning.
Yeah. It has to be done prior to the sale, because once you get the money in hand, now you're taking receipt of it. And really, a lot of the good strategies of trying to defer taxes or anything like that are waived bye once that money hits your account. So if you want to try to defer some of these things, if you want to try to mitigate some of the taxes, you got to do the planning prior to that. Otherwise you'll pay. I mean, and look, it's still a better tax rate than what you normally pay on ordinary income, but for the most part, it's still going to be a big chunk of money.
And I got to tell you, I didn't do everything right. I screwed up in certain areas, and I look back and I said, I could have done this better. I only know now because of, educating myself and actually, going through the process of doing research and looking into, writing this book and doing all the research and realizing, this is what I could have done. But I was also part of a larger entity that we were acquiring other entities. So I get to see like, oh, wow, if this was done, I could have, paid less on this end, or I should have had this better team member on my team. Like, my accountant was an accountant, but he wasn't, geared towards what I should have had him geared towards. So I learned all these things, unfortunately, but I'd love to be able to give that information to somebody else who can benefit from it.
Well, looking back on it, like, what would you, I'll ask, first question is, would you do it again? Would you sell?
Yeah, I would do it again, because the reason that I was doing the sale was because I wanted to 10x my company. Okay. And what I mean by that is I could go at it on my own, but I wasn't able to negotiate rates with insurance companies because I wasn't big enough. Okay. I wasn't on their radar. In my area, ACOs, accountable care organizations, were sprouting up. Hospitals were buying over the primary care physicians and literally telling them where they could send their patients. So I just thought it was getting harder and harder. My margins were going to be shrinking in the future. And I thought this was a good opportunity to work with a larger entity. Now, I chose a private equity entity that wanted to get in healthcare as a vertical, as opposed to a strategic. And the reason I did that is because I spent so many years training myself to become a CEO of a company, and a strategic would basically want me treating patients all day. Not that there's anything wrong with it. I like that part of it, but I felt like I could hire people to treat patients. Doing the CEO role in this organization, in that role, I could serve people better. I could serve the organization better. So the newly formed, private equity who we were getting to be a part of, they wanted that role for me. They wanted me to make sure that my operations did okay and to help out the whole entity. So basically, I wanted to be a big fish in a small pond as opposed to a small fish in a big pond.
Yeah, that makes sense. Okay. What would you have done differently though? Anything, like any major things you'd have done differently? Would you have negotiated any differently? Would you have structured the deal differently than you did?
I think the negotiations were fair. I knew a lot of the players there, so there was a lot of comfort for me. Yeah. I think they were swift in their thing. That's what I also requested. I said, I don't want this to drag on and on and on, because it takes a toll. You're not focused on your main operations as much, and you're expected to keep up your main operations. So that's another test. Sometimes they purposely drag things out just to see, is his numbers going to dip? If his numbers dip, that means really he's at the helm and doing everything. But, I just didn't want my mental capacity being challenged by, dealing with this the whole time. So they were swift to close. I think it's a good idea that you always do your homework on the private equity sponsor. Had I done more homework, I don't know if I would have found out anything different, but I think that's a good idea that people sometimes don't realize. If somebody has a track record, maybe, if they have other partners, to actually talk to the other partners and find out what's going on. Now, if they're a newly formed private equity that's going into a vertical that they've never done before, then that's a little bit more challenging.
Yeah, then you just have to kind of trust the operator at that point in time. And
now, I was young enough that I figured if everything went to crap, I could start it all over again and I would be fine. So I also had that cockiness about me that, look, I've done it once before, I can do it again. So let's go, but let's build it and let's do the best we can.
Yeah. Okay. So you do it again.
I would do it again. Yeah. Because I think that was my next step. That was my evolution.
Yeah, that makes sense. And then post sale, now it's like, what do I do with all this friggin' money that you got, And I think that's another challenge that a lot of people have of coming up with a plan to allocate this lump sum of money that you're going to get, or maybe it's spread out over, a 2 to 3 year period of time.
Yep.
And, it's my contention that you can't look at the investment portfolio the same way that you did prior, because now you're going to have this lump sum of money and, the game maybe isn't so much, rates of return, like is the primary focus. It's like, how do I make sure I keep this money? How do I make sure that it creates something for me?
Yeah.
And, because once the business is gone, it's gone.
Yeah.
And you don't really realize how much cash flow it provides you. But you got pretty deep, in researching alternative investments and those kinds of things as well. But tell us your experience on that part, what to do with the proceeds.
So I started, that's a good question. I think before the acquisition even came up, I was also looking into real estate because I really like real estate, but I'll be honest, I was scared. I was really scared about the fact that somebody's going to call me saying my toilet's broken. Here I am trying to build my physical therapy company and didn't want to deal with that. So I looked into what are known as syndications, and the syndications are basically, I'm a passive investor. I get a certain amount of rate of return, and then when they sell, you get an additional amount, right? And I know that I'm sharing it, but if it's passive and I can actually get passive income from it, for me, I was like, well, if I build up my passive portfolio and I continue to have passive income coming in, it can help offset my active income as far as what I need. Therefore, if you're offsetting your financial needs because you have all this passive income coming in, you're less reliant on that active income. Yes. So that was my thoughts. So I started diversifying in different parts of real estate and different things. Some were ATM, some were actually multifamily, some were oil and gas, and some were I'm trying to think self-storage. Actually, you helped me with a self-storage one that did fantastic. Yeah. But yes, I liked having that diversification in that portfolio. Now, this had nothing to do with stocks and things like that. So I'll be honest with you, I started getting irritated by the stock market. I felt like I had no control. I felt like I was on a roller coaster, that when you need the money, it could be down and you're like, well, now I'm stuck, There's positives and negatives. Now, when you're dealing with syndications, you're doing the best that you can and do your homework on a company to find out, are these good operators? Or, you can find out that they're not good operators, and then your money's lost there. So, but you ask somebody in the stock market who invested in Enron, they lost it there. So there's no guarantees.
There's definitely not. And there's risks in anything. And, I'll tell people, whether you're investing in the stock market, which is more public securities, priced daily, you have to deal with, public sentiment risk. You have to deal with, and there's ways to diversify that risk and all that. And I totally get that, but it's still, you're dealing with things that have a volatility to them. And it's the same thing with the syndicators too, who aren't that much different than some of the operators that buy PT practices. You know, they find something that they know that they're, you know, supposed to be good at, and then they manage those properties. And, you know, in those cases, you know, when I look at like past performance in stocks and bonds, honestly, that doesn't mean anything to me. It really doesn't, because that goes through cycles, and it has a different view. I have a different viewpoint on that. But when you are investing in a private investment like that, that person's track record does matter. That person's character, that company's, you know, integrity, their systems, their people, their story, how they've done, what's the worst I mean, I remember asking like, the storage facility. I was like, what is the deal that you guys just effed up on? I want to know, you know, what did you do and what did you learn from that? And they told me, you know, they were really transparent. And even then, that's not a guarantee that these groups are going to do well, because they're subject to the same outside, you know, high interest rates and leverage and all these other things as well. So, all I would tell people is, like, when you sell your practice, you know, and you get this huge lump sum of money, you know, make sure that your first order of business is risk management. Like, I'm going to speculate in some areas, but I also need to like make sure that I have money in places that is for sure in some way, shape, or form.
Diversification, right? And in different buckets, you know, like you said, some are conservative, some are as if somebody's getting into retirement age, they're still not taking aggressive risks, right? They're being a little bit more conservative. This is the same way. You're getting a large sum of money, so you have to allocate it, you know, appropriately.
And that's when I think diversification matters, because when you were growing your practice, I mean, 80% of your net worth was in your practice.
That was one of the reasons why I wanted to go outside of my practice, because what most people do is they just keep putting it into their practice, which is great, but you're putting it all into one bucket. And I wanted to have other buckets that I could, you know, get money from. Yeah,
that's for sure. Okay, cool. And then what's your life like after exiting? How's it been?
It's been interesting. You know, I've been doing some consulting work. What happened was I was actually helping some real estate people because, you know, I enjoyed it. I enjoyed helping some syndicators. They were raising funds, and, you know, they found that I was really good at it. So I helped them for a while. And then what happened was interest rates changed, and the, you know, PT offices that I had known, some of the PT people that I have known, had been asking me for help. And at the whole time I was like helping them, no problem. Let me help you, but not like putting together a plan. It was just like off the cuff help. And then I said, okay, you know what? Let me actually put together a business plan and really help these people. Let me take a look at the finances. Let me put a structure in place for them. Let me try to educate them on what I was educated on as an owner. Instead of the day-to-day, let me just see more patients. You know, the philosophy of, you know, let me treat more patients and I will get more money is not the right answer. You know, there's, you know, I did a video recently. You know, it's a difference between playing checkers and chess, right? You know, checkers is just like, let me see as many patients as I can and I'll make the most money as I can. Chess is, let me be strategic about how I look at my contracts and which contracts I don't want to take, and rather focus on the higher paying insurance companies and put out a better quality product than, you know, trying to cram as many people as possible and putting certain systems and plans in place. So what I'm doing now is helping those private practices, and, you know, people like yourself that I talk to, you know, always ask the same question, like, what was your exit like? So I really enjoyed the exit part of it. I really enjoyed the negotiating part of it and the understanding part of it, you know, and realizing what team members I need. So now I'm doing some research and getting into writing a book. I'm going to be taking some executive level MBA classes on basically exit planning and how to help practices, you know, get ready for the exit, you know, specifically for physical therapy at first. But plus I enjoy it. I really enjoyed digging into that.
Yeah. Okay. So you're I guess you would call yourself a business consultant, but you're going to be more towards an exit consultant, right? You want to get these people
What's actually really interesting, what people don't realize is if you're actually applying the things that you're supposed to, you shouldn't be waiting until the exit to do it, because if you apply it now, you're going to gain more value for your practice now, which means every day you're going to be making more money. And the goal of most practitioners is, let me make more money now. I don't want to worry about the future, but doing the correct steps, you're going to make more money now, and you're going to be setting yourself up for the future. So I don't want to wait for those people to figure out they want to exit and then put the plans together. I want to start working with them so they start making more money now. And ultimately they live the life and have some freedom right now as opposed to later.
Yeah. And then they can make a decision on when they want to exit, and they can do it on their own terms, and, know that they're going to ultimately get the highest value possible for their business when they do that.
Yeah. So any company that's looking to buy another company, things may change, but, profit margins people will always look at.
Yeah, for sure. They do like that. That will go on forever.
Yeah, forever.
All right, buddy. Well, that was fun. If people want to reach out to you, what could they do?
They can feel free to email me. My email's, really long, and it's hard to actually spell out and actually follow. So I don't know if you have show notes, but it's amit.gaglani@agmgmtinc.com.
I'm sure we can fit that in there.
I hope so.
So yeah.
They can follow me on LinkedIn as well. If they look me up, Amit Gaglani, PTOCS or OCS, they'll be able to find me there as well.
Okay, man. All right. Well, thanks so much, bud. That was really helpful. I appreciate that.
Yeah. And the company that I have is AG Management Consulting. So
excellent.
Awesome. Thank you.
All right. We'll see you guys on the next podcast. Be well.